Satya skills. In this video, let us learn 50 important points on insurance. Insurance means assurance of compensation against loss and is a protection against loss of insured risk. Insurance can be defined as a contract between two parties where one party called insurer agrees to pay to the other party, the insured, a certain sum of money on the happening of a specified contingency and agrees to indemnify the insured from losses arising from specified events. In this point, there are three question answers for your reference. Then, the first insurance company established in India was Oriental Life Insurance Company in Calcutta in 1818. In 1829, Madras Equitable Company started insurance business in Madras Province. British Insurance Act was passed in 1870. This is the first act. Indian Life Assurance Act 1912 was the first statutory measure that is especially to regulate life insurance business in British India time. Insurance Act 1938 was the amendment to the Act 1912 to give more protection to public. Insurance Act 1938 is more comprehensive and provisions are there to control insurance business more effectively. Insurance Amendment Act 1950 abolished principal agencies. This is after independence by Government of India. On 19th January 1956, an ordinance was passed by the Government of India and nationalized life insurance business. The Life Insurance Corporation of India, popular as LIC, was established by the Government of India in 1956. Insurance is a cooperative mechanism of spreading loss of risk over a large group of persons. This is a very important point, remember. Risk is the base on which the concept of insurance, business of insurance is built. A large variety of risks are covered under insurance. Concealing the truth that affects any fact, subject matter of insurance makes the contract invalid. Insurance is a contract of indemnity except life insurance or accident insurance. Indemnity means in case of loss, insured shall be paid the actual amount of loss, not exceeding the amount of policy. Contract of life insurance is not a contract of indemnity. It is not. Why? Because insurer is liable to pay the amount mentioned in the policy upon the happening of contingency, there is a risk, or after a specified period. Thus, it is called contract of contingency. Life insurance is a contract of contingency. Insurable interest is an important component of insurance. Insurable interest supports the contract and makes it valid because the object of insurance is to protect insurable interest. The insured can recover loss only if it is proximately caused by the risk insured against. This is called the principle of causa proxima. Proximate implies the cause which is truly responsible for the loss. Contract of insurance can be enforced only if the risk is attached. Remember, insurance is only for future risk. Principle of contribution means distribution of risk amount payable to the insured among all the organizations. In case of loss, any one insurer may pay the insured amount of the loss. It is a general adjustment. Principle of contribution is applicable when same property is insured under different policies. Policies cover the same risk which caused the loss. All policies are in force at the time of loss. One of the insurer pay the loss amount and he collects from others later. The principle of subrogation applies to fire and marine insurance. The principle of subrogation implies that after making payment to the insured on the event of loss, he is entitled to be in the place of insured. When the insured receives full indemnity in respect of loss, the insurer will be entitled to the every right of the insured. That is, after payment, the company will get all the rights. If at any time the insured recovers more than the full indemnity, the insurer is entitled to recover from the insured the excess amount. General insurance or fire insurance are for certain period, usually a year. The contract comes to an end after the expiry of the period. The primary function of insurance company is providing security to the monetary loss. Insurance can be broadly classified into two groups: life insurance, general insurance. Insurance may be direct insurance or reinsurance. Direct insurance means insurance taken by the individuals, called retail insurance. Direct insurance includes both life insurance and non-life insurance and is more regional business. Reinsurance is a wholesale business. It arises out of the need to reduce the risk bearing burden by the insuring company by sharing the risk with other companies. To safeguard the company's interest, it may insure the same risk with other insurer. This is called reinsurance. Reinsurance is one where insurer purchases the risk from the other insurer who insured the risk from an insured. I gave 3 ways of answering the question on reinsurance. Please go through clearly. 3 I gave. In proportional form of reinsurance, the amount retained and the amount ceded will be representing the fixed share of risk covered by the direct insurer. Quota method of reinsurance, the ceding office is bound to reinsure such proportion of every risk as per the agreement. Share surplus method of reinsurance is when a risk is proposed, the ceding office has a free choice within the liability specified in the agreement. Non-proportional reinsurance, the ceding office will underwrite its retention as a form of first loss insurance. It bears losses up to certain figure only, that you need to remember. Double insurance is one where the same party is insured with 2 or more insurers with regard to the insurance benefit of same interest on same subject matter against the same risk for the same period. Under this, the same person is entitled to benefit from 2 or more insurers, that is insurance companies. Under double insurance, a person can insure same risk with any number of insurers, but can claim the loss, but he cannot recover more than actual loss. In the contract of insurance, the consideration for the insurer is the premium paid by the insured, that is the benefit. Contract indemnity in the essentials of contract, you learned this about this. The premium is returnable when the subject matter of insurance ceases to exist. If the contract is void and was not binding the parties, and if the insured has no insurable interest at any time during the risk, the premium is returnable by the company. If the risk is run even for a short period, the insurer need not return premium. If the insured induces a fraud, insurer avoids the policy, he need not return premium. These last 4 points are important for your exam. That's all.